Rudy Dean stand and John Gostilla stand. Sorry, it's a little tricky with all three. If you would face me and please raise your right hand. I state your name. Do solemnly swear or affirm that I will support the Constitution and will obey the laws of the United States and of the state of Florida, that I will in all respects observe the provisions of the Charter and ordinance of the City of Jacksonville Beach, and will faithfully discharge the duties of pension trustee of the police officer retirement system. Pension of the police officers retirement system. Thank you. I'll have you sign these after. If I could have Mr. Lance Huish, Gaylord Candler, and Deborah White. Not here, not here. All right. Mr. Lance, welcome. Please raise your right hand and repeat after me. I, Lance Huish,
I, Lance Hewitt,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support the Constitution
that I will support the Constitution
and will obey the laws of the United States
and will obey the laws of the United States
and of the state of Florida,
and of the state of Florida,
that I will in all respects
that I will in all respects
observe the provisions of the Charter
observe the provisions of the Charter
and ordinance of the City of Jacksonville Beach,
and ordinance of the City of Jacksonville Beach,
and will faithfully discharge
and will faithfully discharge
the duties of pension trustee
the duties of pension trustee
of the Firefighter retirement system.
of the Firefighter retirement system.
Thank you. I'll have you sign this after. You guys gotta keep working today.
Next is roll call.
Nick Curry,
Here.
Dan Jansen, Christine Hoffman,
Here.
Brandon Maresma,
Here.
Eddie Vergara,
Here.
David Cohill, Marvin Dupree,
Here.
Rudy Dean,
Here.
John Gostilla,
Here.
Jason Sharp,
Here.
Gaylord Candler, Ed Dawson,
Here.
John McDaniel,
Here.
Lance Huish,
Here.
Debbie White.
Okay, approval of minutes. All the boards for the joint quarterly meeting held February 8th, 2022. We need a first and a second from anyone from any of the boards.
So moved.
Second. All in favor?
Aye.
Any opposed? And then the consideration by the police officers and firefighters boards for the special joint meeting held on March 22nd, 2022. Again, motion and second.
Motion.
Second. All in favor? Aye. Any opposed? Okay. Next, we're going to have Mr. Pedro Herrera for a legal update.
Go ahead.
Okay, good afternoon, everybody. Hopefully you guys can hear me okay. So just a couple of things to go over, nothing actionable, but just more housekeeping items. Excuse me. First and foremost, I just wanted to close the loop legislatively. So there had been one bill that was filed that would have provided an additional presumptive disease for police officers and firefighters for purposes of line of duty disability or pre-retirement death. So as you guys are aware, currently the statutes in the city ordinance mirrors is that the Florida statutes provide for certain communicable diseases that are presumed to be incurred in the line of duty. So if, for instance, a police officer or firefighter suffers from heart disease, hypertension, tuberculosis, meningitis, fire firefighters have 21 different forms of cancer as well. If any of those illnesses or diseases cause a disability, then it is presumed that that disability is burden of liability. It doesn't mean it's presumptive, it's not final. It can still be rebutted. However, again, it shifts the burden over to the board to disprove that it was incurred in the line of duty. So this bill would have added COVID-19 to that list. It did not pass. It died in committee. My understanding is that it did have broad support. The major stakeholders, organized labor, the League of Cities, they were in favor of it, or at least not directly opposing it. However, I'm sure you guys read the news and see the newspapers. There were some controversial issues, to be polite, in the legislative session this year. So I think it really just got put on the back burner and it really just never came on. It just stayed there. So typically it takes 2 to 3 years for a bill or an amendment to become law. So I would expect that it will be filed again next year and probably make it through. But obviously we're computer posted. Other than that, there were no changes legislatively that would affect our clients. Any questions on anything of the legislative session? Okay. And then also just in terms of updating you, I know we're getting to that time. It's that July 1st deadline where your financial disclosure forms, those Form 1s that we love completing each year, they are due. So if you don't already have a copy, I'm sure Dustin can get you one. The city clerk's office probably has them. We can get you, or you can Google Florida Form 1. I'm fairly certain it's the first hit that comes up. But either way, just recall so you can email that form in now, so it's a lot more user friendly. Excuse me. Or obviously as in the past, you can send it in by mail. We do recommend certified mail, return receipt, or you can hand deliver it to a supervisor of elections office in the county where you reside, which may not be necessarily where you're working. But do try and get that in. If you can't get it in by July 1st, historically, there is a daily penalty or fine that's assessed by the Ethics Commission, the State Ethics Commission. Historically, they have not assessed that until September 1. So presumably, if you get it in by the end of August, you're still okay. But obviously, it is due technically July 1st. And so what they've done in the past is they've kind of waited until September 1 and then charged the full freight, right, which I think is $2,500, which cannot be paid by the fund or your employer, and has to come out of your own personal assets. So if you need any help on any of the forms, I'm sure I'm happy to help you. If you just want to give me a call or anything like that, but please just recall to get that filed. If you filed one last year, you're probably going to get one in the mail. You may have already received it. I think I heard folks just started receiving it now. It seems like they're going out later and later in the mail. They used to go out early May. Now it seems like they're coming out early June. But not getting it in the mail is not an excuse for being late in your filing. So again, if you can, just put that on your radar and get it filed by the end of the month.
Pedro, this is Dustin. I emailed that out earlier today, and we have paper copies here for anybody that needs it.
Oh, perfect. Okay, there you go. Excellent. Also, I think, and I don't know right now, I don't recall, but if there are any city commissioners or anybody on the board who's required to file a form because of another position that they serve on, you don't have to file multiple forms, right? You just file one form, and there's a line on the form that, I think it says, why are you filing, or something to that effect. So you would just include, kind of both positions on that one form. You don't have to file multiple forms. I know in the past we've had a couple of city commissioners on the board. I don't know if that's still the case, but just in case. And then just last, I wanted to touch on just some educational opportunities coming up for the board. The FPBTA has its summer conference coming up June 23rd through the 26th. I'm sorry, June 26th through 29th over in Orlando. And then the state division of retirement will have a school in the fall in Orlando. sure to send those over to you. But other than that, there's really nothing else that I had for my report.
Okay, thank you. Moving on to new business, we're going to go to Dustin's pension administrator report. It's a little out of order.
Thank you. We're kind of jumping down the thing there. We had some childcare issues I gotta get out of here for, so, jumping kind of back to the back of the agenda, I'm gonna hit the budget first. Starting with 2023 proposed budget, I'll go through and kind of show you what the differences were from prior years and what we kind of changed here. Budget assumptions, investment earnings at 7%, so, you know, our assumed rate of return is 7.5% for the two general police boards, and so we assume 7% to kind of be conservative on the revenue side. And there's, you'll notice later through here when we get to actually looking at the numbers that it's not exactly 7% compared to last year, and that's because I kind of switched the methodology from going 7% off of what was the previous year's budget and stuff like that to going off of what our most recent actuals were that I had for the general and police and fire funds and what they actually had, and 7% of revenues based on that. So I think that's a more accurate and appropriate way to do that, so kind of changing the model there a little bit. Member contributions, general and police and fire, 7.95%. That's remained the same for some years now, and it's codified in the ordinance. City contributions for the general had decreased by 2%, and the increase for the police by 9%, and for the fire by 4%. So the increase for the police is at 9%. I think it is a lot more due to the way we used the funds from last year, where we used some reserves to pay a portion of the city's contribution from prior years. So it makes this year look like an increase when really it was pretty good results. Tax revenues are based on, it's really difficult to project these tax revenues, so we just look at what we received in tax revenues from the prior year and assume that going forward, and that's really the best we can do there. And then, of course, the fire tax revenue will be going to the city of Jacksonville moving forward. Budget assumptions for expenses, we have total expenses you'll see are fairly consistent overall with prior years. I'll get into some of the details on that and how there's some funds moving around, but when you look at total expenses, it's small variations of percent changes. Personnel services, it's just an allocation of my salary and expenses that go along with that, insurances and things. Those numbers come straight from the city's budget office. Professional services, really the only ongoing annually increasing contract that we have is with ANCO at a 3% increase every year. Pension benefits, every year kind of just have to take an assessment of how many people have passed away during the year, who do I think we are going to have projected to be retiring a year and a half from now to a half year from now, in between that time frame, and just trying to make the best guess we can on what overall pension benefits will be, and that's really what it is best guess. Other current charges, we removed proposal to upgrade pension software. Did remove that last year, but we left in kind of a contingency because we didn't really know where that was going to fall for the software upgrades with the city. So I think this is a pretty good time to say that the city, after talking with their consultants and things, did decide that because most of the people that would be utilizing the pension software would be active employees, that they are going to pay for the pension software themselves. So we have that out for RFP right now. It closes next week, and hoping to have the whole implementation done by the end of this year. So hopefully it won't be a very difficult process, and we'll, fingers crossed, that's best case, I think, but we'll see how it goes. Moving on. General employees revenues, obviously no taxes there. Investment earnings, it said, it's up 15%, not 7. Well, that's because of the change, and that 7% being based on actual. Member contributions and city contributions, that's coming directly off the actuarial work from Brad. And that's about it for revenues. Pretty simple. The expenses are what we really control, and personnel services, you see the expense there on personnel services going down a little bit. That's mainly because I declined the city's insurance, and so they don't have that expense anymore. So once you balance that out a little, it decreases a little bit overall. 3.7% increase for the investment. That's the ANCO line there. The 3.7 instead of 3, just to get to round numbers in the budget of 14,000. Management and custodial fees, that's 36.9% drop. So that is year over year, where we had just been budgeting kind of based on what our previous budget had been. And the more I looked at it, I saw these numbers are no longer aligning because of some changes we had made in the past, where we reduced our overall expense ratios. I mean, we're at 0.44, so 44 basis points now overall as a plan. So when we went to Vanguard and got some lower expenses overall, it really changed our total expenses. So when I look at it, this 155,500 is a lot closer to the actual that we need, and so just trying to get everything in line this year, and hopefully in the years going forward we'll be able to have a better trend analysis and less of an adjustment here. But pension benefits, again, that's just looking at who all has passed away, who all I think may retire in the next half a year to a year and a half, and trying to project that out. Other expenses, we've got kind of a big jump there, and that's mainly because in the accounting sector for the last 19 years, the accounting and the city has only charged the plans $99,750 for all the accounting services that they do. And I mean, quite frankly, they've been under billing for quite some time for everything that they do. They issue all the 1099s. They are recording all of the investments and tracking everything and expenses, and then putting together the financials, doing state reporting. There's just a lot that goes into it, and that number also covers other expenses such as cutting the actual paychecks, and the amount of time for like the payroll person that goes in and makes the adjustments for people making direct deposit changes, all that kind of stuff. So everything that is that makes the administration happen, really the nuts and bolts of it is really in that number. And so when accounting looked at it, and they made a kind of a change to the way that should be done, and it's now based on the way they do the rest of the city, based on the operating budget. So that's, if we look on it's more in the detail of a few pages back, you can see the actual, what it went to, 64,000 instead of 9,750. I know that's a huge jump, but I don't think it's inappropriate in any way. As a matter of fact, I think it's still a pretty good deal for everything that the services they're providing. And I don't think it's anything that you could go out and get a third party to do any cheaper. And this is, because it is based on operating budget, that number is kind of shocking, but it applies mostly to the general plan. It's a lot less for the police and fire, because it's, again, based on their budget. Alright. Anything from the general board on, specifically on general? On police officers, revenues. Again, the taxes just based on current year or prior year actual, so they come in at 303,000. So that's what we budget for 2023. Investment earnings, same kind of conversation here for the 7% and change in the process there. Member and city contributions based on the actuarial report, giving us an overall budgeted total revenues increase of 16.8%. And the expenses side for police, we have personnel services going up 3%, but again, these are just numbers that are coming from the city's budget office. Not much of a change here. Same thing with the ANCO, an additional $500 there for the 3% increase. And then management custodial fees down 33%. Same conversation as the general about kind of reassessing how much we're actually spending and budgeting for and getting it closer to actual. Pension benefits pretty consistent there with the police department. Don't see any upcoming large disbursements in the near future for backdrop. Not for 2023 fiscal year anyways. And other expenses, the 22% increase there, 24,000 to 40,000. Again, same thing. It's just the accounting adjustment in the way that they are expensing out how much they're actually spending there. Questions from fire or police?
When you do the backdrop, since obviously they can do it anytime,
Yeah.
no longer past that time, how do you,
I'm just
what
looking
percentage
at,
of budget, if anybody's over that time, they can do it,
Yeah.
what percentage do you budget for them?
it's not, it's more based on the conversations I've had with each of them, because as people do get closer to retirement, I'm speaking with them and kind of got a feel for who's going to retire when, and just do it based on that. So several of the ones, I mean, we had Commander Evans that did the backdrop, but a lot of them are just not even doing the backdrop, and just getting to the end of their normal retirement date and not doing the backdrop. And so there's no real additional budget that's going into that. On the firefighter revenues, again, 0 for taxes. In the paper form, I have a blank there, and I updated my presentation to include county, the word county. We are including the county, meaning city of Jacksonville. And I use the word county because that's what accounting has in our financials. But we didn't budget for their portion of the firefighters' revenues last year, but we're going to start doing that now, and I think that's appropriate to do. It is a known number. Old directly from the actuarial report, so. As time goes on, you'll eventually see that 707,000 this year. I think we have a 10-year payoff on that, which we're in year, I think this is budgeting for year 3 of that, so maybe 4 actually. Total revenues increase of 30.3% there. On the firefighters' expenses, pretty consistent down the board there. Again, same thing, investments, the ANCO, management custodial fees, again, decreased 27.5%. Pension benefits, I mean, this one actually decreased because we had a few people pass away, a couple of beneficiaries pass away, and I don't know of any pending retirements for firefighters. Exactly. There's none within this fiscal year anyways that we're budgeting for that I'm aware of, so shouldn't really see any cost increase there. Other expenses, same thing with the accounting as before. Any questions overall on any of that? That's it. So I'll do my pension administrator report after, so I guess you vote, we vote to approve. the
Vote to
budget.
accept the budget. Okay, we'll do this by board. Why don't we start with the police? We need a first and a second, and we'll do a roll call.
Motion. Second.
Marvin Dupree,
Yes.
Rudy Dean,
Yes.
John Costello,
Yes.
Jason Sharp.
Yes.
Okay, general board, first and second.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brenda Maresma,
Yes.
Eddie Fugara.
Yes.
Firefighters, first and second.
Motion approved.
Second.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Huish,
Yes.
Debbie White,
Yes.
Thank you.
Yes, sir. Pension administrator's report, the main thing that we were gonna talk about is stuff that Pedro already hit on with the Form 1, the upcoming FADPA conference that we've got a few people going to in the summer, and then they'll have one in the fall as well, and then there will be the police and firefighters conference as well, which we haven't been going to, recently during COVID and everything, they kind of stopped doing that, and then I think they had one virtual, but we're not push this next one a little more. I've been to it before, it's a well-done event. So maybe not as lavish as the FABTA, but still good information and specific to police and fire. Our next meeting will be August 10th, 3 p.m. And that's actually a Wednesday, because in August on Tuesdays they always have the budget workshops on Tuesday. So we always have a conflict there, so we always move our August meeting to Wednesdays. I will mention that as far as trending on how many participants we have and things, our vested number in general is still dropping and has been for 2 years now, where, back 12 years ago, something like that, it was, we had a hiring freeze and all that, so we're still kind of recovering from that, from people who started just after that, and everything, but we have increased just since September 30th to the end of March. We have 7 additional employees, so trying to get the city back up to full staff on full-time employees and people who are contributing to the pension there. So that's a good trend going that way. And I hope the next quarter is better. I'm sure it will be. That's really about it for that, I believe. All right.
All right. Okay. We've got general employees, trustees, we've got some approvals. Application for retirement, Lorraine Trundle, admin assistant, parks, deferred retirement effective March 1st, 2022, separation date December 23rd, 2020, meets age and service requirements for deferred retirement, 15 years of service. Need a first and a second from the general board.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Eddie Vigara.
Yes.
Okay, another application for retirement, Clifford Abshire, cut-in, cut-out technician, Beaches Energy, backdrop, retirement effective date June 1st, 2019, separation date May 31st, 2022, meets age service requirements for backdrop service retirement, 23 years, 6 months, first and the second, general board.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Eddie Vigara.
Yes.
Okay, and then Richard Amato, application for retirement, bus relations conservation coordinator, Beaches Energy, backdrop retirement effective March 1st, 2021, separation date July 29th, 2022, meets age service requirements for service retirement, 13 years, 4 months, first and a second.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Eddie Vigara.
Yes.
Okay, Police Officers Board, application for retirement, Paul Watkins, Police Sergeant, backdrop retirement effective April 1st, 2022, separation date April 17th, 2022, meet service requirements for normal retirement, 25 years, 1 month. First and the second.
Motion.
Second.
Marvin Dupree,
Yes.
Rudy Dean,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes.
Okay, we're gonna skip Bradley.
Yeah, it had been so long since our last meeting there, I accidentally put Brad on it twice. We're gonna put it in twice.
Okay. And Consultants report presentation.
Yep.
Start with Brad.
They're gonna pull it up for you, Brad.
There may be one or two new trustees. Does everybody more or less know what an actuary is? Most people want to be on the asset side of the balance sheet. Actuary finds their home on the liability side. So I'm your liability specialist. I'm going to be pretty quick. I'll tell you why. These results were determined as of October 1st, 2021, and do not reflect any experience since then. So I'm sure, at least with respect to the investment markets, everybody's fairly familiar with what's been happening this calendar year. But the results overall are very good, and they're positioning us well for whatever the fallout could be with the October 1st, 2022 evaluation. So just keep that in mind as we go through the results. And, a lot of the methods that are in place purposefully to moderate contribution volatility to the city of Jacksonville Beach specifically are going to be very prominently on display for 2022, which will first affect the 23-24 budget. So the results are good, and they're for the 22-23 budget. So we're still a year away. Plus, we don't know what the markets are going to, unless Grant.
I thought you had that one.
I made one prediction a long time ago, and I've stayed out of that business ever since. So the annual evaluations are performed for the purposes of determining the annual required contributions. So each of the boards, if you accept the reports today, and in fact they become an invoice. In the case of the firefighters, it will become an invoice both to the city of Jacksonville and apparently the county, as we call them here, the city of Jacksonville. And we also determine the funded ratios of the systems as of October 1st, 2021. And we look at some of the trends beyond the contributions and what your experience was like over the last year. Oops. When you push on the hard surfaces, the arm buttons, it doesn't do anything. So anyway, I'm also not your technology expert, I'm your liability expert. This financing diagram is more specific to the general employees retirement system at this point. The police officers would be a little bit less mature, so where those red arrows are, a little bit less is coming from investment income at this point in time. And the firefighters are the closed groups, so ultimately we expect those cash benefits to crest and decline. I expect next year that I'll have at least one more financing diagram that will be specific to the firefighter situation. The concept of present value, we've gone over this most years, but basically there's a probability that money will be paid. So if somebody works long enough, qualifies for benefits, retires, each month we look at, is this person alive? If so, we owe them a monthly payment. And if that monthly payment was $1,000, and it was due 1 year from today, the general employees and the police officers' retirement systems are assuming 7.5% interest. And so we would have an equation of $1,000 divided by 1.075, which means if we have $930, we expose it to investments at 7.5%. It will grow to be the $1,000 that we need. In the case of firefighters, their interlocal agreement ties their assumed rate of return to the City of Jacksonville Police and Fire Pension Fund assumption, and that decreased from 6.9 to 6.625% from the 2000 to the 2001 valuation. And interestingly, although it's not shown here, if you reduce the investment return assumption, that $930 becomes $938. And so things get more expensive. You need more money if you're not going to earn it through investments. You either need more money now, more money through employer contributions or employee contributions, or in the case of a 6.65% assumption, that would be less money from investment return. The next graphic is basically just breaking down when you have unfunded liability, we have an amortization schedule. So a piece of that is paid off each year, and present value of future normal costs, yearly normal cost is paid, and very purposefully and deliberately it pays off all of the expected debt. Now, Now, here's a page which is probably one of the most important representations in terms of what is our collective purpose here and its benefit security. We're trying to make sure that there's 199 general retired members and beneficiaries, 42 police officers, 23 that are currently in pay status. And we want to make sure that every month they're receiving the appropriate amount for the pension benefit, and will continue to receive that for the remainder of their respective lifetimes. Active members, we're setting aside money for those members as well, so there's quite a number of additional members who we're setting aside assets so that when they qualify and go into pay status, will likewise be meeting the pension payroll on a consistent basis. The funding value of assets is a process to moderate some of the volatility inherent in markets. If you have the market value as of September 30, 2021, for example, or 2022 for that matter, that's the closing hour of trading. It's one moment in time. We're saving from many decades, and so in terms of funding, we don't need everything at that moment in time. So this is a budgeting tool, plain and simple. It's to stabilize the employer contributions. The member contributions are fixed primarily by collective bargaining and the ordinance. And so the city's contribution has an impact on the city's budget, as you just witnessed with Dustin's administrative report. So if there's too much volatility, it can create an additional burden on the city. So the differences are phased in over 4 years, so it's almost like we're amortizing over 4 years. So instead of that one moment in time, we're looking at that one moment in time, 1 year prior, 2 years prior, and 3 years prior, and we're averaging those in effect, so that we're averaging over a 4-year period as opposed to a single moment in time, so that we have a better idea of what the trends have been with respect to the assets. And we don't need it all. We don't need all the money tomorrow. These people are getting monthly payments, so numerically, and we'll spend a little bit of time on this page because this is the good news. This has a pointer, doesn't it?
Green button.
So I'm highlighting 2022, these columns 2022. These are big positive numbers. Those, because we're recognizing investment return over a 4-year period instead of as a moment in time. Well, the results that you're looking at today are based on just 1/4 of very good 2021 experience. And so if we have negative experience, quite negative experience, we start off with very large figures to offset that for the next 3 years. It won't be until the 4th year, hopefully the markets will recover. The last quarter of 2022 and 23 and 24 will produce some investment gains. So it's fairly rare that there's an actuarial emergency, and the actuary is typically going to put you on the edge of your seat. But in case anybody was worried about the 2022 report, we have a lot of reserves. In effect, you can think of these as savings to moderate any contribution rate increases associated with the market climate during this fiscal year. So now, these are rates primarily. The firefighters' rates are less and less meaningful because they're closed. Their payroll is eventually going to zero if we have contributions. Does everybody know you can't divide by zero? It's undefined. So anyway, that will blow up. But in terms of the fringe benefits, the city portion to the general employees is 16%. Between the state and the city for the police officers, it's 14.79%. This is the invoice. So when you see this page, these figures represent the city's contribution requirements should you accept these reports this year. The general city contribution is 2.3 million, police 433,000, and the fire is 984,000 total. But when you look at the smaller box on the lower left, which is here, the reason the 680 is less than the 707 is because the city had a remaining contribution reserve of sorts from prior to the consolidation, and they've exhausted that now. So the 707 is going to be a consistent figure for the city from here on out. You know, for the next 6 years, you're going to see 707, 653. That's a fixed schedule, and the 289,000 balancing item is the city of Jacksonville. So in terms of the volatility, going forward, only the city of Jacksonville will experience volatility for the firefighters' retirement system. And here's some projections, which, if we look at the dollar amounts, these for the dollar amounts for the city are trending downward because we have unrecognized gains in the asset valuation method. Likewise, for police, those are trending down. Chances are they're not going to be trending down once we have 2022 results, but they won't be trending up. So that's the takeaway here. You know, instead of trending down, we expect that the city's budget is probably going to grow with some type of inflation. You know, so we actually expect these dollar contributions to drift up by inflation, but not extremely above inflation. So I think we're in a good position. And here you see the 707 that I referred to repeating for the city because of a fixed payment schedule. And finally, the last slide I was going to cover here is funded ratios. The funded ratios all improved 82% to 85% for general, 94% to 98% for police officers, and even in spite of the change in assumptions from 6.9% to 6.625%. I don't know who came up with that. It's an awful lot of digits. It's kind of a mouthful. It's 6 5/8. Does anybody remember when a share of stock only traded in eights? Anyway, and eight's my favorite number because that's what I wore when I played hockey. So, and it can be considered two circles, or if you put it on the side, it's infinity. But you probably know that already. So the eight. So the firefighters' circumstances, as far as funded, are actually better than 100% funded if you're looking at it from the city of Jacksonville's point of view. The city of Jacksonville has a debt that is not theirs, and that debt is the city of Jacksonville Beach. And when they make their payments, they're actually predicted, because of favorable experience through 2021, they're expected to exceed 100% funded. So that's everything I had with respect. If there's any questions, again, things were very positive, and thank goodness, because if things had been kind of milquetoast, then we would have been in a position where we're staring at the potential for substantial increases with the next valuation. And I think we're in a good position.
We do the approval by board, right? Okay, why don't we start with the police board, the first and the second to accept the actuary evaluation report?
So moved.
Second.
Marvin Dupree,
Yes.
Rudy Dean,
Yes.
John Castillo,
Yes.
Jason Sharp.
Yes.
Okay, general board to vote to accept the actuarial evaluation report?
So moved.
Second.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Dan Jansen,
Yes.
Eddie Guerrero.
Yes.
And the firefighters board?
Motion to accept the report.
Wilson,
Yes.
John McDaniel,
Yes.
Lance Huish,
Yes.
Debbie White.
Yes.
All right, moving on to Ryan with Purvis Gray and Company with their audited financial statements.
Hi, good afternoon, everybody. I'm Ryan Tucker, I'm with Purvis Gray. We're the city's external audit firm, and we also audit the 3 pension plans. You should have a audit report that looks like this in front of you. And then we've got some slides here we put together that we'll go through. Overall, the results of the audit were positive. And the financial results were very positive. As Brad mentioned, 9/30/21 was a good time in the markets, and all of these investments are marked to fair market value at that time. So the numbers look pretty good. I would like to thank Ashley and Eddie and Rosalind on staff for all their cooperation during the course of the audit. Rosalind does a lot of provides a lot of assistance to us in performing some tests of the plan and benefits and all the calculations that are done. So she also writes up the financial statements as well, and we perform the audit. So overall, the results were good. Each plan is going to receive an unmodified opinion on the financial statements. So that is the highest level of assurance you can receive from a CPA firm. So congratulations on that. We've got some other required communications that we have to provide. It's in a separate letter that just briefly, it talks about the accounting practices and if there are any changes in the prior year in your accounting practices. There were none. Any significant estimates, we have to pay special attention to see if there's any management bias over those estimates, which are fair value of your investments. We test those against published fair market prices as of 9/30. And then the actuarial assumptions, we were comfortable with those. There is one sensitive, I suppose, disclosure in the financial statements regarding the fire plan and the state contribution that was, it used to be submitted to the city of Jacksonville Beach and submitted to the city of Jacksonville. That did not get made during this time period. It was about $134,000. That's going to need to be made up with interest, and I know Ashley is in contact with them to get that resolved. So they're working through that now.
We were asked to be involved and write a letter, which we did, to the city of Jacksonville Beach.
No difficulties encountered during the audit, and no significant audit adjustments or disagreements with management, so that was all good news. These are the four required parts of an audit report. Every pension financial statement for a government entity will contain these four items. The independent auditor's report is going to be on page 1 and 2 of each report. Management's discussion analysis will be on pages 3 through 9 of each report. Of course, that's prepared to give some highlights, some financial analysis, and there is some year-over-year comparisons and some 10-year graphs and charts and trends, so that if you don't have time to read through this whole thing, that is one area I would recommend you try and take a look at. The basic financial statements are on pages 10 and 11, and then 12 through 21 are the notes, and these are required disclosures for every governmental pension plan, significant accounting policies. There's some investment disclosures in there about the investment maturities of your fixed income portfolio, your credit ratings, and the net pension liability, which we'll talk about in just a minute. But a lot of information gets pulled together and it's required to be in the notes. And then we have required supplementary information, which is in the back. There's 4 schedules in the back of the report. Those are required by GASB. We'll touch on those. Those schedules are not covered under our audit opinion. I should mention that. All right, the statement of fiduciary net position. This is basically your balance sheet for the pension plan. It's, like I said, it's a snapshot in time of the investments and assets and liabilities of each plan as of 9/30/21. And I should mention that these investments are at mark-to-market fair value. And the 5-year trend here I've got on the screen. You can see this is the general plan. It had almost $70 million at the end of the day in net position over a 5-year period. That is about a 32% increase. That's in the 5-year time frame. The percent change from the previous year is 15.4, which is a little bit less than your net money-weighted rate of return for the investments. It's mainly because the general employees plan has a higher percentage of distributions going out of it compared to its net position. But overall, this is one of the best years you've had on record. The police plan is at 31.9, so just under 32 million at the end of that time period, 9/30/21, and that was a 19.1% increase from the prior year. And over a 5-year time period, it's a 45% increase. So things were looking very good at that time, as I mentioned. And then the fire plan, also a 19.1% increase from the previous year. And over a 5-year time period, that was a 48% increase in net position for that plan. Now, this is the statement of changes in net position. So it provides a view of current year inflows and outflows of each plan. And we'll start with the general employees. And you can see additions were just under 15 million, led by net investment income. As I mentioned, that was the highest year in many, many years. Not just this 5-year period, but even further back than that. Benefits and refunds were at 5.4. The last 2 years there have been some backdrop payouts, so you see those jumping up. And in addition, I think there's 198 retirees receiving benefits during that time, and that was up about 5 from the prior year. So if you want to see how the administrative expenses, those have pretty much been flat these last 5 years, around 100,000 in each plan. Actually, here's the police officers plan, and total additions were 6.5, which is the best year. Benefits and administrative costs were 1.36. There's 41 retirees receiving benefits during that time. I know 2019 is kind of an outlier year in terms of benefits on the graph up above, and there was some large backdrop payouts during 2019. And then the fire plan, of course, there's been some changes in the funding to that plan after the interlocal agreement. But in terms of benefits, there's 23 retirees receiving benefits, which was down 1. In 2020, there was a backdrop payout, so the benefits were a little higher, and also in 2019. But I should mention that all three plans have made their employer required contribution, so that was good, with the exception of the state contribution this past year to the fire. RSI, required supplementary information. These schedules are going to build. They're in the back of the report. These schedules are going to build to 10 years, and so far we have 8 years in there since this, which is since this standard, this new accounting standard was implemented. And this is a schedule of changes in the net pension liability. This top part up here is the total pension liability. Brad computes this. He puts all kind of assumptions about mortality and pay increases and expectations about what's going to happen to your retirees into a black box, and he computes a number. And it's the total pension liability comes out, and we compare that to the actual plan net position, which is essentially what we audit. And the difference is what's called the net pension liability. And this has to be reported on the city's financial statements. And as you can see, it's at $4.6 million at that point in time for the general employee plan, and 93.78% funded. This is all as of 9/30. These balances, which is a little unusual. It's not a smooth 4-year smoothing like Brad does, but this is all as of a date. So this will jump around, but it turned out that was a good day to cut it off, and so the funding of the plan will look good when they record this on next year's. The city records this on next year's citywide financial statements. They record it 1 year behind. So the other thing I would mention is anytime there are assumption changes, you can see what happens to the liability. These first few years and even going back, there were several assumption changes, and those are described in the notes to the schedule. But this one that took place in 2021 actually reduced the liability. On the police officers, you actually ended up with a net pension asset as opposed to the liability. So that was good. $2.1 million going the other way. So it's an asset that will be booked on the city's government-wide financial statements. So that one's in really good shape during that time period. And the police always is a little stronger. There's been more turnover and more active plan members compared to retirees. And then the fire plan is at 93.84% funded during that time, which has been in the 70s, the high 70s over the last several years, so a big jump there. One last thing I'll go over, these are in the schedules. It's required disclosure about the sensitivity of the net pension liability to changes in the discount rate. So Gas came up with this a couple of years ago. They wanted to see what would happen if you increased or decreased the discount rate. What would happen to the net pension liability? And you can see that on the general plan, currently at 7.5%, a $4.6 million But if you decrease the discount rate to 6.5, it almost triples the net pension liability. Same goes for the police. Right now, it's a net pension asset, but if you decrease the discount rate to 6.5, it jumps up to a liability of 1.37. And then on the fire, you're at 7% now, and if you decrease the rate to 6, it goes up to 3.8%. So that is all in the financial statements. I think that pretty much covered everything I wanted to go over. As I mentioned, the numbers look great. You don't want to cut it off today. Hopefully, this will all rebound soon, or at least by 9/30/22, and have another good year next year. I'd be glad to answer any questions.
All right, thank you for that. Let's vote to accept the audited financial statements. Let me start with the firefighter system then. Motion and second.
Motion to accept the report.
Second.
3 seconds.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Huish,
Yes.
Debbie White.
Yes.
And we'll jump to the police.
Motion. Second.
Marvin Dupree,
Yes.
Rudy Dean,
Yes.
John Gostilla,
Yep.
Jason Sharp,
Yes.
Okay, and then the general board, motion and second.
Motion approved. Second.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Dan Jansen,
Yes.
Brandon Maresma,
Yes.
Eddie Vergara.
Yes.
Okay.
May I be excused, please? Absolutely. I appreciate you all. It's great working with you. Thank you.
Thanks, Roger.
Thanks, Brandon. Okay, we got Brendan up. He's going to talk about the quarterly investment performance report and our intermediate fixed income manager.
Good afternoon. I know you've already been here for a little while, but unfortunately I do have, a few extra things to talk about, and also just for the benefit of the new trustees, I'll try to go through just a little bit slower. I'll start by just explaining who we are. We are Anco Consulting. We are a third-party investment monitor and consultant. So we don't physically manage the money, but we help the plan with the drafting of the investment policy and then adhering to that investment policy. And then on an ongoing basis, if managers out of compliance or we have performance issues, we would obviously assist the boards with making some changes if necessary. So as I kind of run through the book, I'll try to start. It's just left and right, isn't it? Are you doing that or am I doing that?
I'm doing it, you try it now. All right.
Not doing anything. I've got the little button kind of beep or blinking at the top. I don't know if that
Okay.
means anything, but. Everybody does have paper copies in front, so maybe in the meantime, I'll kind of start with that. You have it both in your agenda packet, but also a separate handout book. So I'll start with the thicker book, and I'll begin on page number 4. If you just look in the upper right-hand corner, obviously as good as things were in 2021, we turned the corner, and this was not a great quarter. So what you'll notice on the upper right-hand corner is all of the major asset classes. Domestic equity, large and small, international, fixed income, all of them were down pretty significantly. There was no place to hide. Often when equities are down 5, 6, 7%, at least your fixed income's up 2, 3%. Well, in this particular quarter, that was not the case. It was also down more than 5%. If you move down to page number 5, again, focusing first in the upper right-hand corner, just contrast the blue bars and the green bars. Blue being value, green being growth. So you can see quite a dramatic difference between value and growth within the quarter.
And then also, if you move down to the bottom right of that page, I want to focus a couple of things on the one-year basis. So the second little section of numbers is the 1,000, right? Our large cap, this is very similar or close to the S&P 500. Notice the large cap growth return is up 15% for the last year. Now, if you move up, you'll notice the Russell 3000, which is the 3,000 largest companies, were up 12.9%. A little bit less than 15, but fairly close. Now look at the mid cap and the 2,000 in green. Negative 0.9 and negative 14. So 2,000 of the 3,000 companies were negative to significantly negative, yet the index was still north of 10% rate of return. So what I'm trying to demonstrate to you is there's a pretty narrow band of companies that did well, that also have very significant weights within the larger part of the universe. And kind of with that, I'll jump, now that I got the clicker working, thank you. I'm going to jump ahead to page number 7, because we can see that in a little bit more detail. So I'm in the upper left-hand corner. Now this is looking at the Russell 1000, kind of a combination of growth and value. But you'll notice the top 7 names in the Russell 1000, Apple, Microsoft, Amazon, Tesla, Alphabet, and NVIDIA. Well, guess what? Those are all on the growth side, more specifically. And they have significant weights. If you look at their quarterly returns, the worst performer was down 8%. Some of them were even positive. And so again, what that's showing you is the top of that index dramatically outperformed. And actually the top 10 holdings inside the growth benchmark now represent about 40% of the benchmark. The top 2 positions, which are Microsoft and Apple, represent 25% of the index. And so, as a manager, when you're putting together a portfolio, typically you have a maximum cap of 5%, 7% of your portfolio being allowed in one position. Well, in growth, that automatically puts you at a half weight or less of these top names. And as we see here, those by far have been the best performers. So I just kind of wanted to preface that because it's a little unusual, and you'll see that especially when we get to the all-spring portfolio in just a minute. I'm going to go back one page and just kind of back up and talk about sectors, which normally I would never do. But given what's been happening in this market, notice there are only 2 sectors, energy and utilities, that were positive. Also, those are very heavily weighted in the value benchmark, but really don't have a weighting at all in the growth benchmark. So again, not really a surprise. In particular, energy, with Russia's invasion of Ukraine, caused oil essentially to double. And so obviously that helped the energy sector at the expense of virtually everything else. So now I'm going to skip a handful of pages and just talk about fixed income for a minute on page number 11. Focus down in the bottom right-hand corner, the Treasury yield curve. So certainly the Fed, within the first quarter of the year, came out and raised rates for the first time in March. They've since raised again. If you think back to essentially 1st of January, the expectation was that the Fed was going to be raising probably in June and most likely 3 times by the end of the year. By the time we reached the end of March, the expectation is they were going to raise 7 times by the end of the year, and it was going to begin in March. You know, an acceleration of the program and an expansion in terms of how much was going to happen with interest rates. And the bond market ran out ahead of that. So we've had 3 increases in rates as of today. As of the printing of this, only 1 increase had actually happened. But you'll notice the 2-year had gone from 75 basis points to 2.25, 1.5% after only a 25 basis point increase. And as of today, so I'll quote the 10-year, that's the most often quoted number in the press. It was at 2.34 as of the end of March. Today it's 3%. So the market has essentially fully priced in the next 5 to 6 interest rate increases, and they may or may not happen. Certainly with gas prices being up, inflation being an issue, now interest rates certainly higher, that's going to begin to have a slowing effect on the economy. And so there's a little bit of a balancing act that the Fed is going to have to do. But again, just wanted to highlight because that is a very dramatic move. It is not very often you will see interest rates jump like that inside of 3, 4, 5 months. All right, that is everything with the kind of the market background information. So we'll just kind of touch on the plan assets. Again, this is a chart we look at all the time. So we finished the quarter with 115.3 million. Sorry, I'm on page number 14. And so the blue line represents your combined asset total versus that red line, which is sort of a theoretical value based on the assumed rate of return. Now, in earlier years, the assumed rate of return was higher. Now it's down to 7.5%. But had you been able to just earn the assumed rate of return with no fees, the portfolio starting at the $11.8 million in 1987 would have been worth $98 million. But instead, your actual value as of the end of the quarter was $115.38 million. So a very significant increase above that assumed rate of return. All the while, your cash flow on a combined basis is pretty significantly negative. So you started with, again, call it the $12 million back in 87. Since then, you pulled out on a net basis $30 million. Yet, all the while, been able to grow the asset total up to 115. So again, very, very nice relationship in terms of the long-term investment program. Next couple of pages get into the asset allocation by manager and asset class. Just want to touch on something real quick. Allspring versus JP Morgan. You'll notice JP Morgan is about 18.4 million versus Allspring of 16.1 million. We haven't really seen that for a while. For the past 3 and 4, 5 years, as we needed money for benefit payments or to rebalance, that money was always coming from Allspring. They were always $2, $3, $4 million larger than your other portfolios when growth was doing very well. Now we've seen that reverse, value doing better than growth. And so value is certainly up by a couple of $1 million here. And actually, as of today, it's closer to about a $3.5 million gap where value is above the growth manager. But with that said, when we have our normal rebalancing, as you have benefit payments, now instead of drawing from growth, which is down, we'd be drawing from value, because that's the one that has performed relatively well. But just kind of wanted to give you some insight on that. Next page looks at the asset allocation relative to target. So what you will see, again, a continued overweight to domestic equity, underweight to fixed income, which is offset by that cash position. That is intentional. As we were rebalancing over the last 18 months, as you remember, we were getting to that 65% cap. We saw higher interest rates collectively as a board, and you didn't want to put the money into fixed income, so we were holding that in cash. And so you will see that certainly did benefit the plan due to the recent performance. All right. So now, with all of that said, let's jump to the performance on page 21. Certainly, it was not a good quarter in relative terms, nor in absolute terms. So the plan was down 5.78%, behind the benchmark, which was down 4.8%. For the fiscal year now, the 6-month number, we're down 1.8 versus a positive 0.14 for the benchmark. As you get out longer term, 5 years, 7 years, 10 years, you can see that ranking still very strong in the upper 20 to 25%. But certainly the more recent numbers have did less than what we'd expect and hope for. As you move down the page, just to touch on a few of the managers quick, Allspring, which I referenced, was down about 12.5% versus that benchmark of down 9%. Again, that gets to that concentration perspective. They don't own 13% of Microsoft. And if you didn't own that much, you were behind. And certainly you can see that over the trailing periods. To contrast the underperformance from Allspring, we did have JP Morgan, which was positive 24 basis points, nothing to write home about, but the benchmark was down about 75 basis points, so nice absolute performance. And for the last year, now about 14.7%. Eaton Vance or the Atlanta mid-cap portfolio had been a bit of a struggle last year, if you recall, but they've kind of turned that around nicely. It is negative, down 4.7 versus 5.8, but ahead of the benchmark, and if you look at the last 12 months, now 7.5% versus essentially flat for the benchmark. Then on the next page, the other kind of problem areas for the fund in terms of relative performance were our international managers. Both Euro-Pacific and WCM both have a bit of a growth bias, and as I kind of referenced earlier, growth has really been impacted in this last 3 months or 5-month period. So both of these funds were down north of 10%, 12.2 for Euro-Pacific, and WCM was down about 17%. Now, you will notice if you get out to, say, 3 years, certainly 5 years or the longer period, these managers have done very, very well for you. But in this period where the market kind of really transitioned from growth to value, and in reference to the Euro-Pacific, they do have a little bit of emerging market exposure. So, when a Russia invades Ukraine, and that really impacts the emerging markets more so than certainly the domestic or developed markets. So you see a little bit of that impact there as well. Then as we move down, we get into fixed income. So Sawgrass is our core quality fixed income manager. They were down slightly ahead of the benchmark. They were down 4.5 versus about 5.65 for the last year, down 3.7 versus 3.9. So they have outperformed, but certainly has been in a negative environment as interest rates have moved up. Just as a reminder, instead of taking that equity cash and rebalancing it back into fixed income, we left it in cash. So it was earning not much, 2, 3, 5 basis points, but it was positive. Had we put it in fixed income, it would have been down 5% or 3%. Certainly that did contribute positively to the overall performance over the last 12 months or so. Our other fixed income piece is PIMCO Diversified. Again, down a little bit more than the benchmark, 7 versus 6. Outperforming, but it's still negative for the last year, 4.3 versus 6.2. Again, same issue. You've got higher interest rates across the globe, and then also the dollar has strengthened recently, in particular in light of the Russia invasion of Ukraine. And so, any foreign bond earnings or foreign holdings, as you bring them back to a appreciated dollar, that also hurts the returns on a relative basis. Then the very last piece of the portfolio is really the one big bright spot. Real estate with JP Morgan was up 6.5%. Now that did underperform the benchmark, which was actually closer to 8%. And for the last year, 26.5%. Now, if we were all sitting here a year ago and said, hey, what do you think about the prospects of getting 26% out of real estate? Most of us would probably say that doesn't seem real likely. But as the market has evolved, as inflation has kicked in, that does help the portfolio. As interest rates move up, that helps the portfolio because there are mortgages inside of the portfolio. And as interest rates move up, those mortgages actually become more valuable. So it doesn't completely offset certainly what's happening in the bond market, but it is a net positive. And then the other thing that is really being seen is sort of the lingering effects of COVID, where multifamily housing and industrial in particular are doing phenomenally well. As the Amazons of the world continue to build out industrial complex and all of that distribution online, the prices in industrial in particular have really been accelerating, and that's a big part of why you're seeing that 25, 26, 28% over the last 12 months. Again, certainly we would not expect that to persist, but certainly something more moderate in the 8 to 12% range I think is more reasonable. But certainly we'll take the 26% while we can get it. That's everything that I wanted to cover from the quarterly book. Let me stop there for a second and see if anybody has question or comment. Please.
So on the fixed, where we moved some of that into cash. If we saw the market trending back better again, would we consider moving that back out of cash, or would we want to keep it there, or?
We certainly could, yeah. Obviously, truly timing interest rates is an incredibly challenging,
Sure.
Thing. So I would hate to say it's like, oh, well, today it looks good, tomorrow it doesn't, or anything
Right.
like that. But But certainly, we're in a much better position, again, 12 months ago, 18 months ago, your fixed income portfolio was earning 1.6, 1.7% cash yield, than the prospect of higher rates. Now today, after rates have moved up, that fixed income portfolio is probably yielding 3.5%. So quite a bit more yield. Now certainly interest rates could go higher still, but they've really kind of jumped out ahead. So I think the chances of that significant move up again from here are certainly muted compared to where they have been.
Okay.
So, and that kind of probably will dovetail into the conversation about fixed income and intermediate that we'll have in just a minute.
Okay.
That might kind of factor into that decision.
Sure.
Good question. Any other questions or comments on anything in the quarterly? If not, there's one other page that is not plan specific. I can't. I lost the signal again on this. I think it's page 53 of your book. With inflation certainly percolating here, we just wanted to put together a little chart for you to give you some perspective. So what this chart does is it looks at each calendar year where the CPI change year over year was north of 6%. And certainly 2021 was one of those years, and I would expect by the time we finish this year, this will also fall into that category where the CPI has more than a 6% increase. And then what we've done is just include both the S&P 500 return as well as the Barclays Aggregate Bond Index. And really the short version is returns are all over the place. There's no real pattern. And that was one of the questions that we were starting to get from folks is, well, now that we're seeing inflation, is that going to mean negative bond yield or bond returns or negative stock returns? And you can see some years they're up, stocks are up 30%, some years they're down 25%. There is no real pattern to that. And of course, we summarize the results in this little box kind of in the bottom right-hand side. So you can see certainly stocks have averaged about 5.6%. Now, you could say because we had such a fantastic year, just due to law of averages, we're probably slated to be below average this year. And that's certainly the way the year has started. But interestingly, the bond return in inflationary periods has still averaged 2.8%. The one caveat that I have to give you, because again, that seems a bit unusual. If you look, but the main part of this representation is from 1969 through 1981. It's the vast majority of the years that are being represented there. When you started in 1969, interest rates were roughly 7.5%, 8%. And they went from there up to 17%. But the idea when you started in 1969 is you were getting 7.5% yield that would offset a lot of the losses from higher interest rates. If you move that forward to today, or well, really 12 months ago before rates started moving up, we were only getting 1% yield on the 10-year or maybe 1.6% on a broadly diversified portfolio. So you have a lot less yield to cover up capital losses if and when interest rates rise. So again, I expect this year, or certainly last year, next year, to be well below that kind of bond return average in these inflationary periods. But again, nothing specific to your plan, but just thought you might find that interesting and wanted to talk through that today. Any questions? All right. Is the other presentation separate, or is it just a separate? Okay. So as a follow-up from previous meetings, obviously we had explored a few different conversation points about maybe getting some changes to whether it be quality restrictions or other things that the ordinance does not permit. And we weren't going to get anywhere there, so one of the conversations was, well, within our current ordinance, what else might we want to consider as it relates to fixed income because of the rates, the risk to higher rates. And so this other book, we have, we call it Intermediate Fixed Income Manager Analysis. So it just looks at a couple of things. So what I did is, and really the primary thing I wanted to do was look at the Sawgrass Intermediate Fixed Income Portfolio. So your current manager, they also run an intermediate version or a shorter duration version. But for the purposes of comparison, I wanted to throw a couple other managers into the mix just so you could compare and contrast. So I threw in Robert W. Baird and Garcia Hamilton. And then lastly, I threw in a TIPS portfolio, Treasury Inflation Protected Securities. So not quite the same type of portfolio that you have now. This is more of a passive exposure, but these are government securities that are linked to inflation. So if inflation were to persist for a period of time, there's an argument that these type of securities would tend to hold up better than certainly traditional fixed income securities. One thing that I do need to kind of note technically, down at the bottom, you'll notice the Sawgrass intermediate strategy is not what we call an AMCO approved strategy. It is going through that research process as we speak. That is literally like a 3-month process. And I would expect that to conclude here in the next month or so. But just technically speaking, because that portfolio has not gone through all of those research steps, it's technically not approved. So I did just kind of want to reference that in case you saw that and had any questions. But as we look up at the comparison, let me just highlight a couple of things. So the current Sawgrass portfolio that you're in has a duration of 5.87 years. But you'll notice the intermediate portfolio from Sawgrass is 3.89 years. So not quite half the duration, but approaching that. Again, same kind of quality bias, and each of these managers are all high quality. Baird at a single A average, Garcia Hamilton double A, and then of course the Fidelity, because those are government securities, all of them, that has the AAA rating. Some additional statistics, I thought maybe the most helpful thing would just kind of be look at a quick review of performance. Now, when you go back 10 years, there's not a dramatic difference between these portfolios, with the exception of the TIPS portfolio, because that is essentially a different asset class. But if you look, say, over the last 5 years, our existing strategy has done 2.7%, but these intermediate portfolios are between 1.8 and 2.3, where actually Sawgrass is the better performing of those intermediate strategies at 2.3. But again, because interest rates over the last 5 years have actually fallen, this has underperformed the longer duration portfolio that you're in. And then of course the separate caveat is the Fidelity portfolio has obviously performed very well in the last 12 months. 4% positive return, while all of the fixed has been negative, again, as the expectations for inflation have increased. That portfolio has done very well. So let me kind of pause there for a second, see if anybody has any question or comment before I kind of jump in any further.
Yeah, I have a question.
Sure.
Are these managers constrained as far as their duration? I mean, they're intermediate. They have to stay there.
Yeah, essentially you're going to be plus or minus 20% of the index. Is generally, because otherwise you're not intermediate anymore. If you go more than 20% less than the index, you're starting to drift into a shorter duration portfolio. And certainly if you go longer than 20, you're starting to drift into the low duration version of the long index. So they're going to have constraints that keep them relatively tight to that respective benchmark. So the one thing that I did want to comment on is, when we were talking about this 4 months ago, the 10-year Treasury was, 2% less than it was now. All of a sudden, in very short order, the market jumped way out ahead and kind of moved before we could take any action. And so one of the things that I contemplated, or in terms of a suggestion, is it may be too late. That's kind of the short version. Now that interest rates are up, obviously we don't know if interest rates are going to continue to go from 3% today to 4% or 5% in the next couple of years. Certainly there's a risk of that happening, at which point being in intermediate would be beneficial. But if rates are relatively stable, then the increase in yield that you get by staying in the longer duration portfolio will outperform intermediate, because again, you're giving up yield to go shorter duration. Or we could consider, say, splitting the difference. That's something else that the boards could consider if we wanted to take a little bit of that interest rate risk off the table. say a half position or something less, that is of course another option. Or flip side, if we don't want to mess with kind of the duration of the portfolio by moving some to intermediate, you could consider like a TIPS allocation or something like that. Maybe that's a smaller dollar amount, because again, it looks a little different because it's more tied directly to inflation. But just something to kind of consider. I know it's thrown a lot at you in short order, but maybe we want to just kind of consider it for next time, but I wanted to make sure I discussed all of that with you.
How much yield are you talking about giving up?
You know, it's roughly 50 to 75 basis points. So it's not a huge number. You know, part of that is the relatively compressed, you know, even though rates have jumped to say 3%, you know, it's certainly not like it was 15 years ago when rates were at 6 or 7%. You know, the spread between long duration and intermediate back then is a larger income spread. So it's still relatively tight. But that's kind of the trade-off or the offset. You know, you're getting the extra yield, longer duration, and certainly if the economy slows and we don't end up increasing interest rates the way the market is pricing in, then you're likely to see rates either stabilize, if not even come down a little bit, at which point that would benefit longer duration and hurt intermediate relative to each other.
I love this idea 6 months ago. Unfortunately, we're making decisions, you know, three months out. Well, we don't have the time to tactically. So I'm with you.
What's the issue with waiting on the Sawgrass and seeing what they're gonna have? You said that's like in a trial period as far as what they're working on?
Other than I can come back to you and say we've done all of the research work on that particular strategy, and it you know, we recommend it, you know, as a potential inclusion. Now that's not going to change the discussion about where interest rates are, where it could be going. It's just, you know, a potential quiver if we wanted to pursue intermediate. And again, they've done a fantastic job for you for a long, long time. And again, we know the team, we just hadn't done for this particular portfolio, we hadn't gone through that process. Any additional questions or comments? Again, my inclination is just to kind of hold pat for now. Obviously, we can revisit this, but again, given how quickly things have jumped in the past few months, I think we may have just kind of missed that opportunity.
Yeah, I'm inclined to stick with you, in my opinion.
If there is nothing further, that is everything that I had for you today. Any other questions or comments that I can address?
Thank you for doing that.
Absolutely.
At least.
Yeah, had we only known that, you know, things were going to move quite that fast, you know, it would have been a different discussion.
Needed crystal ball.
Okay, so we need to vote to approve the first report, the quarterly investment report, not the fixed income report. Why don't we start with the police board first and a second?
Motion to accept.
Carmen Dupree,
Yes.
Rudy Dean, John Costello,
Yes.
Jason Sharp.
Yes.
Okay, and the general board first and a second?
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Eddie Vergara.
Yes.
And the firefighters board, motion to approve or to accept the report?
Motion approved.
Second.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Huish,
Yes.
Debbie White.
Yes.
Okay, and next is the general board to approve setting the expected rate of return to 7.5% for the next year, the next several years, and the long term thereafter. Is there
So moved.
Second.
Nick Curry,
Yes.
Dan Johnson,
Yes.
Christine Hoffman.
Yes.
Brandon Maresma,
Yes.
Eddie McCarr.
Yes.
Firefighters, you're voting to,
It's in the same line. It's general and police.
oh, okay. Police officers, discussion or motion?
Set the expected rate of 7.5.
Sorry.
Motion.
You got a motion?
Marvin Dupree,
Yes.
Rudy Dean,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes.
Okay. Now that we're past that confusion, the firefighters board, we're approving setting the expected rate to 6.625 for the next year, next several years and long term.
So moved.
Second.
Ed Dawson,
Yes.
John McDaniel,
Yes.
Lance Huish,
Yes.
Debbie White.
Yes. Again.
Do we want to do her swearing?
Yep, sure do. Ms. Debbie, we're going to swear you in. Please raise your right hand. Repeat after me. I, Deborah White,
I, Deborah White,
do solemnly swear or affirm
do solemnly swear and affirm
that I will support the Constitution
that I will support the Constitution,
and will obey the laws of the United States
obey the laws of the United States,
and the state of Florida,
state of Florida,
that I will, in all respects,
and I will in all respects
observe the provisions
observe the provisions
of the Charter and ordinances
of the Charter and ordinances
of the City of Jacksonville Beach,
of the City of Jacksonville Beach,
and I will faithfully discharge
and I will faithfully discharge
the duties
the duties
of pension trustee of the firefighter retirement
of pension trustee of the firefighter
retirement system.
retirement system.
Thank you, ma'am.
So before we
Feel the heart
adjourn,
by now.
I was gonna say, you've done that. I just wanted to say something, kind of with my mayor hat on and something we probably don't say often enough, but I want to thank you all for your service to this board. Some of you have been on it as long as, and longer than I've been on it, which is coming up on 10 years now. But I just really appreciate your service. We probably don't say that enough, so I didn't want to miss the opportunity to say that. I wanted to thank the returning board members. We changed up the process a little bit with our, of all of our city boards, with our kind of recruitment and appointment process. So we made you go through an interview. It was a little bit different than the past, but we do appreciate that, to kind of get everything standardized. And to the new members, you picked a doozy of a first meeting, but you saw a little bit of everything. So you've gotten to see I think all of our consultants at this point and advisors, and we have a really great team. So please know that you can use them, especially Dustin, if you have any questions or concerns or anything leading up to or after a meeting. And for you guys to know, we made 2 really great additions to this team. We've got a lot of great relevant experience. I think you guys are going to be valuable resources to us going forward. So they're not always this long. They're not always this, I mean, when you've got an actuary who's cracking jokes about number 8, you know you're on the right board. So,
Well, at least try.
was that?
Well, at least try.
At least try, yeah. You just got to listen in for those jokes. But I just wanted to say that, hopefully I'm saying that on behalf of the council, so you can nod in agreement there too. But we really appreciate your service, and it's a lot, and we value the effort that you put into that on behalf of our city. So thank you. That's it.
That's it.
Any further comments, discussion? All right, a motion and a second to adjourn.
So moved.
Second.
All in favor?
I
Aye.
I got my fire.
If you took an oath